Hello and welcome to ED Insight, where we get you a 360-degree view of the big picture in business and economy. I am Sridhar Ramakrishnan, and here's what we have for you on the show today. The stellar run for gold and silver has hit a speed breaker. So why are these two precious metals losing their sheen, and what should investors expect here on? So is it the right time to buy gold? Should you hold on to your gold investments or cash in while the going is good? Find out the pros and cons of each move with the experts.
Even at the low point of about 1550, gold was still up about 15% this year.
Gold is a buying opportunity right now.
Our top story first. Until a few weeks ago, the world believed when it came to investments, there was nothing as safe as gold. But as they say never. Investors got a rude shock when gold and silver prices plummeted last week. Some blamed it on the higher trading margins and others on the strong US dollar and the debt crisis in Eurozone. But whatever be the reason, investors' faith in gold has been shaken. So what went wrong and what's the outlook? Nikhil Shivadas gets you the story.
American eagles, Canadian maple leaves and Chinese pandas represented the safest investment haven until recently. They were considered safer than equities, bonds and even safer than paper money or fiat currency. Over the past few months, the demand for gold multiplied, but supply remained short. That's because several workers in gold mines in Africa went on strike seeking higher wages. When the strikes were called off, the price of the yellow metal was expected to remain firm on account of higher renegotiated wages and increased demand on account of a loss of faith in paper currency. It was quite literally a golden opportunity for investors. But a rude shock awaited the market last week. Gold slipped by 9.2% in the week, its sharpest weekly fall since December 2009.
Gold prices yesterday declined nearly 3% and they are down nearly that much even at this point in time.
So what really went wrong? Well, almost everything. It all began with gold tracking the global crash in commodities on account of the European crisis and a strengthening dollar. A liquidity crunch made investors sell gold and silver investments to cover their losses. As prices fell, exchanges raised margin requirements. The CME, or the Chicago Mercantile Exchange, the world's largest futures market, raised margin requirements on gold and silver by 21% and 15% respectively. That triggered a further sell-off. While gold prices did recover significantly during the week, the damage had been done. Investors have learnt it the hard way that precious metals are not really the safest bet, and prudence means hedging even the safest bet.
We expect that the gold prices will stay very volatile in the short term, and unfortunately we expect further rise in gold prices in the medium to long term. Why unfortunately? Because we think that it's showing you the missing confidence against the current financial system and against the fiat money. But for the time being, as long as the investors would be seeking for more liquidity, the gold prices might stay under pressure, and we wouldn't be surprised to see the gold prices to fall in even towards or slightly below $1,500.
International market is still weak. There is no money supply, and because of money crunch and maybe other margin shortfall, people are exiting from gold and they are buying other products. So that can be a shortfall in gold. But in MCX, yes, the price has not been breached because of rupee. Rupee is factoring a lot. Rupee has weakened a lot from almost 45 to 50 rupees right now. The future is trading on the second future is trading almost 50 plus. So this is impacting the MCX price. But as soon as the price gets in the consolidation mode, you can see a MCX price falling maybe around 27, below 27,000 also. So right now my suggestion is not to take any position in gold especially. Wait for the decline and then you can start again around $1,700 below.
We are of the opinion that if gold manages to climb over $1,830, then we might see a push again for $1,900 or $1,915, which was the previous high. So we are bullish on the fact that if gold manages to cross over $1,830, then we would definitely be on the buy side in the market.
But this cautious approach still does not take the sheen off gold as an investment. And here's why. The US, the world's largest economy, is still struggling to turn around. There are many countries in the Eurozone that are going bankrupt. And Asian markets, particularly India and China, are saddled with high inflation. Rising inflation eats into the value of money, making households park their savings in gold. A study by the World Gold Council titled Gold as a Tactical Inflation Hedge and Long-Term Strategic Asset, states that gold can prove more effective than commodities, real estate, and sometimes even inflation-linked bonds at achieving efficient portfolios with maximum risk-adjusted returns.
I don't see how you can't think that precious metals will move higher in this type of environment. Essentially, it is a vote of non-confidence or no confidence in the policymakers in the reserve currency countries. That has to be the correct vote until they step up to the plate and really address the underlying concerns of investors about their fiscal balance sheets, and we see very little progress in this area.
Gold's lack of correlation with other asset classes makes it have that extra edge. It may not be the best investment in a high-growth, low-inflation scenario, but it's the best bet in uncertain times when inflation is high and growth is slow. That's perhaps why the consensus among large investors and global analysts is that as long as the US does not start tightening its interest rates, gold prices will tend to go up.
Gold is essentially the only safe haven currency left in the world, with the Swiss National Bank having gone the path of other central banks. There's one safe haven currency less, obviously. The way we look at it is this: gold keeps its purchasing power. It has actually done so over the last few thousand years. And what is happening is that other currencies, paper currencies, are going down against gold. So of course that reflects itself in a higher gold price against these currencies, obviously. And again, it depends. You can put any number on it. It depends how much money Mr. Bernanke is going to print or how many bonds the ECB is going to buy of these peripheral countries. It's anybody's guess. But just to give you some kind of an indication, if you had to cover M1 in the United States by gold, the price would be somewhere around 3,600, which is almost double from here. And that's something we could envisage in the next 12 to 18 months.
Gold will continue to shine regardless of the strength of the dollar, because I feel it's just more of a supply and demand scenario that will support the price of gold. I think the US dollar remain in favour, particularly whilst we still get those concerns in Europe. And whilst we've got those concerns in Europe and no growth in America, I actually feel that that US dollar will remain relatively big. But I think gold in itself, the appetite for gold is not being let out of Europe and America, it's actually being let out of India and China. So it's more to do with their currencies rather than what's happening in the rest of the world.
Unlike paper currency, gold cannot be printed. It has to be mined. According to estimates, 2,500 tons of gold is mined every year, and in recent years, demand has outstripped supply. In fact, gold prices have risen every year since the year 2000, but more sharply in the wake of the 2008 financial crisis. Which means that unless the world economy makes a dramatic U-turn, gold prices are likely to keep glittering. So what should investors do?
Don't sell your silver, don't sell your gold, unless you're a short-term trader. But anybody who's in this for the long term, silver and gold will both go much higher over the next few years.
Sure it has. In fact, gold has outperformed all major equity, commodity and bond indices across developed and emerging markets. With gold touching an all-time high this year, there's a case for correction in prices. And even though the market is divided on which way the gold prices will go here on, indications are that there's still more steam left in the rally. So how much of a correction are we talking about, and what's in store? Investment guru and author of the Gloom, Boom and Doom report, Mark Faber, told ET Now that he remains bullish on gold and said that if gold falls below $1,500 an ounce, then it could go as low as $1,100 an ounce. But the outlook, mind you, remains bullish.
I'm not selling my gold because I think in the long run they will print money. As soon as markets in the world are down another 10-20%, even the Republicans will write a letter to the Fed, you have to ease. You understand? Now they can sit back and say, don't ease, we have done enough. But as soon as asset prices go down and the economy is weak, everybody will again applaud the Fed if they print money.
That's the reason why market experts remain bullish on the yellow metal despite the recent volatility in prices. Standard Chartered has reiterated that gold prices will touch $2,000 an ounce by 2012 and stated that prices can go up to $5,000 an ounce in the next 10 years. HSBC has revised its 2012 gold price forecast from $1,625 previously to $2,025 an ounce. And GFMS has stated that gold will easily spike through $2,000 an ounce by the end of this year.
Gold is still a good bet as a physical buyer or an investment guy who's actually wanting for long to go long in gold and was not willing to spend money at 29,000 levels. These are the right levels to go because we have the festive seasons coming out and obviously Diwali is around the corner. Festivities across the world will begin from now. We could see good buying opportunities and gold may trigger some good returns going forward. So yes, as an investor, I would prefer to go long. Maybe I would decide to put 50% on my investment portfolio in gold at current levels.
If you look at the decline in all the other metals, gold has not really still broken its support of 25,500. So though we would still say that in the short term you should sell it at about 27,200 and cover it again around 26,600. We still feel that unless you really see a break on the downside below 25,500, only then we could say there is a trend reversal. Until then, yes, it will be volatile, but the long-term uptrend is still in place.
As capital seeks a safe haven, gold will surely not lose its luster anytime soon. So who will demand gold? Well, almost everyone, from central banks to fund managers to households. And India and China are expected to drive demand for gold in the coming months. According to the World Gold Council, in the second quarter of this year, world demand for gold was near record levels of 920 tons worth $44.5 billion. That's not all. India and China accounted for 52% of total bar and coin investments and 55% of global jewelry demand in this period. Experts expect this trend to continue. With the festive season around the corner, there's little reason not to believe that. And that means gold will continue to shine in the months ahead.
But that's not to say gold prices will not be volatile in the months ahead. So what should investors do? Stay with us.